Welcome back to your channel name, your go-to source for the latest in financial news and market updates. Today, we're diving into the remarkable rally on Wall Street during Election Day, and what it means for investors amidst a solid U.S. economy. Stay tuned to understand the factors driving this surge and what to watch in the coming weeks. On Tuesday, November 6, 2024, U.S. stocks saw a significant rally as voters headed to the polls on the final day of the presidential election. The S&P 500 climbed by 1.2%, nearing its record high set just last month. The Dow Jones Industrial Average surged by 427 points, marking a 1% increase, while the Nasdaq Composite gained 1.4%. These gains came despite the prevailing uncertainty surrounding the election results. So, what's fueling this bullish sentiment? Several factors are at play. First, despite the election uncertainty, recent economic data paints a picture of a resilient U.S. economy. Reports indicate strong growth in the services sector, beating economists' expectations for a slowdown. The Institute for Supply Management noted the strongest growth in over 2 years, suggesting sustained economic momentum. Additionally, the upcoming Federal Reserve meeting on interest rates is on investors' minds. The consensus is leaning towards a potential rate cut for the second consecutive time, which typically acts as a catalyst for stock market gains. The presidential election always adds a layer of complexity to the market dynamics. Historically, U.S. stock markets have shown resilience regardless of the election outcome. Since 1945, the S&P 500 has risen in approximately 73% of the years when a Democrat was president and about 70% of the years under Republican leadership. Experts like Sam Stovall, chief investment strategist at CFRA, highlight that while each administration brings different policies affecting various industries, the broad market tends to trend upwards over the long term. This historical trend provides a level of confidence for investors, encouraging them to maintain a long-term focus despite short-term electoral uncertainties. Paul Christopher from Wells Fargo Investment Institute advises against getting swept up in pre-election moves or immediate post-poll volatility. He suggests that any initial market reactions are likely to temper or reverse before or after Inauguration Day, emphasizing the importance of a steady long-term investment strategy. Maintaining a long-term perspective allows investors to navigate the inevitable fluctuations that come with election cycles, focusing on the underlying strength of the economy rather than the political noise. Election-related stocks have shown notable movements. Trump Media and Technology Group, the company behind Truth Social, experienced significant volatility, tumbling 20% in after-hours trading and closing 1.2% lower during regular sessions. This stock tends to react sharply to Donald Trump's re-election odds rather than its intrinsic profit prospects. On the flip side, Palantir Technologies saw a remarkable 23.5% jump following a strong profit report driven by unrelenting demand for artificial intelligence solutions. CEO Alexander Karp stated, "We absolutely eviscerated this quarter, driven by unrelenting AI demand that won't slow down." This highlights how sector-specific trends like the AI boom can significantly influence individual stock performances. Looking back, the S&P 500 has demonstrated impressive growth post-election. Following President Joe Biden's win in 2020, the index rose by 69.6% from Election Day through November 2024. Similarly, during Donald Trump's presidency, the S&P 500 saw a 57.5% increase from 2016 to 2020, partly due to tax cuts that boosted corporate profits. Despite uncertainties such as potential contested elections or a split Congress, the general trend remains positive. Investors often hope for a unified Congress to maintain policy continuity, which can support market stability and growth. However, historical precedents like the 2000 election, which saw the S&P 500 drop 5% during the vote count period, remind us that market reactions can vary. The key takeaway remains to focus on long-term investment strategies and not let short-term political events derail your financial goals. In addition to equities, the bond market also plays a crucial role in the overall economic landscape. The yield on the 10-year Treasury slipped slightly to 4.28% from 4.29%, reflecting cautious optimism amidst the election uncertainty. The Federal Reserve's upcoming meeting on interest rates will be pivotal, as any decision to cut rates could further buoy the stock market by making borrowing cheaper and encouraging investment. The U.S. market's movements also influence global markets. In early trading on Wednesday, November 7th, the Nikkei 225 in Tokyo rose by 0.7%, the Kospi in Seoul was up 0.5%, and Australia's S&P/ASX 200 added 0.8%. These gains reflect a global confidence in the U.S. economy's resilience and the positive spillover effects of a robust American market. Financial experts remain optimistic about the U.S. economy's trajectory. With strong growth indicators and technological advancements driving sectors like AI, the foundation for sustained market growth appears solid. However, they caution investors to stay informed and adaptable, as geopolitical events and policy changes can introduce unexpected volatility. Experts also emphasize the importance of diversification and risk management, especially in times of political and economic uncertainty. By balancing portfolios and staying focused on long-term objectives, investors can better navigate the complexities of the market. In summary, today's rally on Wall Street underscores the resilience of the U.S. stock market amid election-related uncertainty and strong economic data. As always, maintaining a long-term investment perspective and staying informed about market trends are key strategies for success. Thanks for watching. If you found this video insightful, please give it a thumbs up, subscribe to your channel name, and hit the notification bell to stay updated with our latest market analyses and financial tips. Drop your thoughts and questions in the comments below. We love hearing from you. Stay smart, stay invested, and we'll see you in the next video.